Just last November, I reported on the low number of bankruptcy filings rounding on 2022. Today, I'm talking about literally the opposite. So January and February registered the highest total number of bankruptcies for any year since 2011. Consumer discretionary and industrials were the top sectors. Healthcare was, up there with 9 as well. Telecom infrastructure firm Avaya and Sorrento Therapeutics were the biggest bankruptcies last month, $1 billion in assets, while Party City and Serta Simmons Bedding were the more well-known names that you might recognize, primarily driven by higher interest rates and contracting corporate earnings. The bankruptcies, though, come at a time when other U.S. companies, and these companies have high credit ratings, are rushing to take on more debt to satisfy investors looking for yield and get ahead of any other further interest rate hikes. February was actually a record for corporate borrowing, but one expert I spoke to says, don't worry just yet.
What I don't think we see yet are companies that have been doing really well with great business models that have just suddenly run into trouble caused by the current economy. We're still looking at a set of names that have been suffering for a while. And when that changes, that's when we've really entered a new economic cycle.
And his comments were echoed in Fed Chair Powell's congressional testimony yesterday, who said, quote, commercial business debt is moving sideways as a percentage of GDP, and he's not seeing major spikes just yet, but is watching business debt carefully.
So I guess the long-term question, Christina, is what is the impact going to be then on stocks?
Yeah, excellent, because I know that you just spoke about this with Steve Leisman, and the big question is, are people going to be shifting from stocks to bonds? Well, I spoke to public.com, which is a retail trading platform, and what they said is that it's not a question of no, it's a question of or. So according to new research from public.com, what they're saying is that the yields, I just lost my spot there, but it says the shift from high yield is an and not an or. So in March alone, so this is the stat I didn't want to mess up, there is a 30% increase in high yield bond ETF investors compared to last year. So already a massive jump. And then according to research from UBS, this is another completely different report, the quality of high yield debt is starting to be a little bit riskier. They say, quote, 18% of high yield debt due just in 2024 and 2025 looks, quote, much worse than 1 year ago and prior years. So the good thing, though, that I need to reflect right now is that high yield debt for corporations may be riskier, but you may not see it reflected in high yield ETFs that investors care about, like HYG and JNK. So there's a lot of stats I just threw at you right there. But know that, yes, people are shifting to more high-yield debt. They want to get that yield. And according to public.com, they're not sacrificing their stocks for it.
Talk to me at a freshman sort of economics level, if you would, about the rollover issue. If I'm a corporate CFO or a corporate treasurer, and I have a company that has low-rate debt that is coming due over the next 6 months to a year, I've got to be concerned that the rate I'm going to have to reissue, at which I'm going to have to reissue that debt, is going to be double, maybe triple what it was.
Right, which points to just that UBS, unfortunately I didn't have the chart to show you, but which points to why it's so risky in the near term for a lot of these corporations, because they're trying to refinance, but they're refinancing going from a much lower rate to a much higher one in the short term. So we can't discount that, which runs contrary to what Powell spoke about yesterday, which is why I find this whole topic extremely confusing, given that these corporate debt balance sheets they're gonna get a lot worse very quickly soon, and yet we're not raising the alarms just yet.
All right, Christina, thanks very much. Christina Partsinevelos on balance sheets.